financial accounting liabilities are just another element within our financial statement. So if we were to look at one financial statement specifically, which is the balance sheet, we will notice that there are three elements within this financial statement: assets, which we covered in the last tutorial, liabilities, and equity. And liabilities are going to be the basis for this tutorial. So right away, the term liability, it evokes this negative emotion, and you're probably right to assume that because liabilities are generally amounts we owe, they're usually economic sacrifices that we'll have to make. So things like bank loans, because maybe we will need a short-term loan to maybe cover our mortgage, or maybe it's for a business. Maybe we need to finance our operations and we're issuing a bunch of bonds so that we can raise money to continue operating. We'll have to pay back these bonds, and that is another type of liability because it's a responsibility. So before we get lost, let's just create a little illustration to illustrate why or what a liability is. So let's say we have this client named Bob, and he's just walking along to meet his very short banker friend. Obviously, you can tell from my drawing. I'm just differentiating him by giving him a top hat and a squiggly or a crazy mustache. And the banker, or let's say Bob is trying to raise capital for his carpentry / construction business, and the banker, he's like, okay, that's fine. I'm willing to make you a loan given that you have some collateral, and I would just like to see some maybe projected cash flows to make sure that you'll be able to pay me back. So he's like, okay, fine, I'll make you a loan for $10,000 at a certain interest rate. We'll say 10%, because the banker obviously wants a premium on his money because no one gives away money for free. So what Bob receives is he receives an asset, which is known as cash, for $10,000, and he takes on a liability of a bank loan for the equal amount, because that is the amount that he owes and he is obligated to pay back in the future. So let me just transform this, make it a little bit smaller, because I just wanted to describe what a liability is and a definition. So a liability is an amount we owe. A liability is a responsibility or obligation, and we can see this because we're obligated to pay back this $10,000. And a liability is a probable economic sacrifice, and we say probable because it is possible that Bob may default on this loan, or he might not be able to pay it back, so he might declare bankruptcy, and so on. So in the most likely scenario, he is probably going to pay back this loan. And these are just criteria for the definition of a liability. So when we're trying to decide whether something is a liability, we'll probably refer to these attributes of a liability. Let's look at one more example of a liability. It's a little bit more complex than the bank loan we just did. It's actually going to involve the same characters. So let me just grab my brush and we'll start that. Okay. So Bob, now that he has his money, he is going to start his construction business, and the first client is going to be this banker over here, because he's like, hey, I need a new house and your construction business, so could you please create a new house for me, and I'll be willing to pay you an absorbent amount of money for it. So Bob's like, for sure. And the banker is like, okay, I will pay you $100,000. Actually, that's pretty low for a house, but yeah, we'll say he pays him $100,000, and let's say he pays it all to him right away, and Bob starts on the construction job. So right now, Bob has received an asset of cash worth $100,000 for this construction job, and I think most people would normally say this is revenue, but it actually isn't, because Bob hasn't constructed the new house for him. So what it actually is this $100,000 is a liability, and it's actually going to be called unearned revenue, which you'll probably see as you read more about financial accounting. And this liability is, of course, for $100,000 as well. And the reason it's a liability is because you owe him a service, you owe him that house, and you're obligated to provide that house, or the banker is going to get his money back. So that is why unearned revenue is a liability, and that is why we take on a liability when Bob receives this money up front. And once Bob actually finishes the construction, we'll see that this liability turns into revenue, but that's really not for this tutorial. I just wanted to show a little bit more complex form of a liability. So like I've shown, we have two types of liabilities, the bank loan and the unearned revenue. So in the next tutorial, we're going to be talking about what equity is. So I will see you guys in that tutorial. Make sure to subscribe, and any questions, leave them below.